Hi, this is Bill Monty of the Estate Legacy and Long-Term Care Planning Center of Western New York. Thank you so much for taking the time to view this webinar, which I've entitled, How Your Kids Can Inherit Your IRA 100% Tax-Free. With the passage of the Secure Act in the beginning of 2020, it has dramatically changed how your children will ultimately be taxed when they inherit your IRA or 401k or 403b accounts. And I want to talk today about how life insurance can be very effectively used as a planning tool to help negate those income taxes. So thanks again, and why don't we get started? Hello, this is Bill Monty of the Estate Legacy and Long-Term Care Planning Center of Western New York. Thank you for taking the time to watch my webinar, which I've entitled, How Your Kids Can Inherit Your IRA 100% Tax-Free. This happens to be one of the key areas of focus of my practice, particularly after the recent passage of the Secure Act, which became effective on January 1st of 2020. One of the main changes in that new tax law was how it changed dramatically how children are taxed when they inherit their parents' traditional IRA, 401k, or 403b accounts. Before the act, a child who inherited a traditional IRA, for example, they had the ability to take a payment from that traditional IRA they inherited over their remaining life expectancy, which could have been a very long period of time. Now, with the creation of the new 10-year rule out of the Secure Act, the stretch IRA really no longer exists. A child now just has a fixed 10-year period to take everything out of the IRA inheritance taxably to them over just that 10-year period of their parents passing. So it's going to greatly exacerbate the level of income taxes that children will have to pay when they inherit their parents' traditional IRA, 401k, or 403b accounts. So this is an area of my practice that is of key focus in educating clients as to what planning strategies exist to help offset those income taxes that the children will be faced with. And in this particular webinar, I'm going to be focused particularly on how tax-free life insurance can be effectively utilized to create the tax-free capital where the children will be the beneficiary of that life insurance, and they can utilize those tax-free monies from the policy as beneficiaries to help them pay whatever tax liabilities they'll be faced with. And it will allow you to have the peace of mind as the IRA holder that you won't be passing along 65% of your IRA, for example, to your children. I'd rather see you pass all of it and not have any of your estate be shrunk away by any tax liabilities that your children will be faced with as beneficiaries. My biggest concern is with what's occurring recently and all of the borrowing that the government is currently doing, that I'm of strong belief that marginal federal rates will particularly rise in the future, I think in the short-term future as well. And my biggest fear is that when your traditional IRA assets do pass taxable to your children, that they're going to pass at a time when your children will most likely be in their peak earning years, and that'll be exacerbated by them paying federal tax brackets, which are much higher than they are now. So it's just going to greatly exacerbate the income tax problem, particularly when they're forced to take everything out and pay taxes on it over a 10-year period. So I do want to focus on that particular planning strategy that looks at how life insurance can be effectively utilized to negate any income taxes that the kids will ultimately have to pay. So let's get going. A little bit about me. I've been doing this, gosh, forever. My 33rd year of practice. Again, my firm name is the Estate Legacy and Long-Term Care Planning Center of Western New York. Those are my three areas of expertise. I'm not an attorney. I have a lot of letters after my name, but two of them aren't JD. But I know what they know. I just can't implement what they do. So I do recommend my clients go to competent estate planning attorneys, and I do give them some suggestions in that area. But my key focus is in the area of legacy and long-term care planning, where I'm more focused on helping people protect what they have while they're alive and protect what they've accumulated in the event that they need any form of long-term care, particularly nursing home care, which in our area is exorbitantly expensive and continues to get more and more expensive. But also when you ultimately do pass, and I'm trying to help you maximize the legacy that you leave to your chosen beneficiaries and minimize and negate any form of tax liability that they'll be faced with, which right now happens to be income taxes. Estate taxes aren't really a concern because of the fact that currently the estate tax exemption is $11.58 million per person. Married couple can, in essence, shelter over $23 million of their estate from estate taxes. So you've got to be a fairly wealthy individual to worry about estate taxes when you pass away, but income taxes are really what you should be focused on. My concern also is I don't know what's going to happen in November of 2020 with the election. We'll see when that occurs, but if it happens to change over to Democratic control, obviously one of Joe Biden's plans is to take away the current step up in cost basis that exists. And if that happens, that's going to create another level or layer of taxation to children. And that will mean that they'll no longer be able to inherit things that you own outside of an IRA, like your home or a brokerage account that has appreciated over the years. They will no longer get a step up in cost basis. They will pay capital gains taxes on the original basis of the asset. So that's just going to create, again, another layer of taxation. And that's another reason that life insurance really should be looked at as the go-to strategy to offset these taxes. It kind of reminds me of back in 1999 when the estate tax exemption was only $600,000. If you were dealing with someone with a $2 million estate when they passed, they had an estate tax concern to deal with. And that's where a lot of life insurance planning was done to create the tax-free proceeds for the estate to utilize to pay whatever estate tax is going to be due. I don't see that being a concern. Again, you've got to have tremendous wealth to worry about an estate tax problem, but income taxes is something that you should be focused on. And obviously we'll keep our eyes on what happens to the step up in cost basis. But relative to me, I like working with those who are nearing retirement or already retired. So, professionals that are nearing retirement or those who have moved into their retirement years and are just living off of the assets they've been able to accumulate over their working years. I've been doing this for a while. Excuse me. I have a number of certifications, primarily focused on the life insurance planning and long-term care planning areas. Relative to who I like to work with and what their story happens to be, if they're generally people who, again, are nearing retirement or already retired. They've been excellent savers over their working years. They've taken advantage of the qualified retirement plans that they have access to. They've built up a nice mix of assets that they actually want to pass on to their kids and ideally maximize what goes to them. They've potentially heard about this new Secure Act, new law, and they want to know about how this change in the stretch IRA rules will impact their IRA beneficiaries because they want to maximize the financial legacy that they want to leave to their kids and grandkids. And they want to know, how can they minimize or ideally get rid of any federal and state taxes that they'll have to pay when they ultimately inherit their taxable retirement assets. So they're out looking for advice and guidance, and they want to know who they can work with that has that type of expertise, and that's where my practice comes to the table. My mission in working with people as a legacy planning expert is to help you preserve and protect your estate that you've worked hard to accumulate. Again, during your lifetime, protect and preserve and take advantage of things to protect your assets from the potential of needing long-term care during your lifetime, particularly nursing home care, which again here in our area is incredibly expensive. Currently averaging $485 per day for a nursing home. That's somewhat ridiculous, but it continues to rise. But on a legacy planning scale, I want to help create a scenario where you've got the peace of mind that you can pass away and pass on all of your assets someday without any worry of any form of taxation. That's what I want to create for the people that I work with. Ideally, that is where life insurance comes into the fray as an excellent planning strategy for those who have the resources, either through discretionary income, having more income than their expenses, and they have the ability to reposition non-needed income into life insurance, or they maybe were people who have also saved money outside of their IRA, and they've got some non-qualified assets they built up, either through their own savings or through an inheritance they may have received, but they have some dormant money there on that side that they could reposition and get the automatic immediate magnification that life insurance creates by kind of treating life insurance as an alternative asset class that they can further diversify their non-IRA portfolio into. So, the question is, did you know that your kids could lose a third or more of their IRA inheritance to income taxes? And what I mean by that is when you ultimately do pass away, what occurs is that your children, as beneficiaries of your traditional IRA or 401k or 403b account, have to open up what's called an inherited IRA. And that inherited IRA accepts the IRA inheritance. And right now, with the Secure Act and the change of the stretch IRA rules, your children simply have 10 years only to extract everything out of that inherited IRA and pay taxes on it. So dependent upon what their bracket happens to be, both federal and state, they could lose 1/3 of that to taxes. So only 2/3 of that is actually going to be going to them. And that's what's called estate shrinkage. Why would you want 1/3 of your IRA to go to the federal government? I want to make sure that that doesn't happen. Fortunately, I work with people who say, Bill, make sure you educate me on everything that I can do so the government doesn't get a dime more than what they should. And those are the type of people I like to work with. You've worked so hard to grow your asset base. You're hoping you can utilize that asset base to give you a nice, healthy, comfortable retirement over your remaining retirement years. Let's also make sure that happens, obviously, but let's make sure that all of your assets pass to your beneficiaries, and let's minimize any form of taxation that they'll have to deal with when that inheritance occurs. 3 common legacy planning strategies that you can utilize to make sure the kids inherit the IRA 100% tax-free. Obviously, I'll be focused here on utilizing life insurance. I think that's the most effective means to create the tax-free capital that the kids will be able to use to offset any taxation. But obviously, there's other things that can be done too, which we'll look at as well. There's something that's called tax bracket management. And what that is particularly these days with marginal federal rates being at the lowest level they've been at in history, it really is the best time to take advantage of Roth IRA conversions and moving some of your traditional IRA assets over to a Roth IRA and paying taxes at these low marginal tax rates right now. In 2020, a married filing joint taxpayer, the 22% bracket goes all the way to taxable income of about $171,000. So if your taxable income is $71,000, for example, you can move $100,000 into your Roth IRA from your traditional, and that will only be taxed at a 22% rate, with the logic being that you're able to pay taxes at a much lower rate now than what your children will be faced with at much higher rates if you didn't do that and they inherited it in the form of your traditional IRA. So that has to be looked at as well as another means to lessen the amount of taxable IRA assets that you have to minimize that taxable inheritance down the line. So we'll certainly take a look at that as well. Obviously, I'm focused on long-term care protection and the protection of your assets while you're alive. One of the things that has become very, very popular has been these life insurance long-term care hybrid plans or combination plans, which kind of kill 2 birds with one solution. It allows you to create a life insurance policy that will generate the tax-free death benefit to your kids as beneficiaries if you never need long-term care. So it provides the tax-free capital through the life insurance for them to use to pay the income taxes on anything that they'll inherit that's taxable. But in the event you need long-term care, you can tap into that life insurance amount on a tax-free basis to pay for your long-term care. So these have become very popular. Um, Long-term care insurance, traditional long-term care, standalone long-term care policies still exist. There's less and less providers in the state of New York, but the New York State Partnership Plan still exists. And we look at it for those who have the assets to protect and the health to qualify for it. But it's become very expensive, unfortunately, these days. And people are generally looking to take what they would have put into traditional long-term care, and they're looking more towards these life insurance-based long-term care asset protection policies. But for this webinar, what I've done is I've done a estate legacy and long-term care planning informational workshop, gosh, since 2013, and in 3 of the towns around Rochester, in Perrington and Webster and Brighton. And one of the things that I do a number of case studies during that workshop, but one of the case studies I'm going to be reviewing with you during this webinar. And again, that's how specifically life insurance can be utilized with your existing resources that you may have, either through discretionary income that you may have or non-IRA legacy asset money that's sitting dormantly. Let's move on and take a look at that case study. This happens to be how you can utilize your existing traditional IRA and take withdrawals from that and reposition those withdrawals into life insurance to create that immediate magnification that life insurance creates on a tax-free basis. This case study happens to be, it's an arbitrary case, actually happens to be a couple that came to a seminar of mine last year. They happened to be both retired. Tom was 72 years of age. His wife Joan was 69. Their objective was they had which you'll see, a fairly decent amount in a traditional IRA, which they knew was going to move taxable to their 2 kids someday, and that was concerning to them. They wanted to see what could be done to offset that taxation. So they looked at life insurance, and they were healthy enough to acquire it, and they certainly had the available resources to fund a policy that was somewhat meaningful for them. So their legacy planning objective was to create a tax-free legacy for their 2 children using what's called second to die life insurance. And that's designed for married couples or partners that it's 2 insureds on one policy. It's like a joint policy, and it doesn't pay the tax-free death benefit until the second passing occurs. Nothing occurs at the first passing. If Tom passes away first, let's say, it just becomes a policy owned by Joan, and then Joan, when she passes away, that's when the tax-free benefit goes to the named beneficiaries on a tax-free basis. So in this case, after they attended my workshop, they came in and they did a good job of letting me know what their current assets happen to be and what their expenses are. And I got a good high-level understanding of where they stand financially. Found out that Tom's IRA assets at the end of 2019 were $770,000. Joan was a former teacher. She had a 403B, which she rolled to an IRA, and she had $332,000 at the end of 2019. So it gave them a little over $1.1 million in total IRA assets. Now, they also had non-IRA assets of about $250,000. Majority of that came from an inheritance that Joan received from her mother. Relative to required minimum distributions, Tom actually turned 70.5 years of age in 2018. So he was subjected to the old RMD rules that were before the Secure Act occurred. So his RMD began in 2018. Again, a required minimum distribution is the amount the IRS says has to be extracted out of the IRA because they want to finally get some of the tax dollars that they've been waiting for. And before the Secure Act occurred, at age 70.5, when you turn 70.5 in the year you turn 70.5, that's when you had to take out a minimum amount. Tom's was about 30,000 in 2000, and actually this year, his RMD for 2020 was going to be 30,000. Now Joan, because she doesn't turn 70.5 years of age until 2021, she's subjected to the new RMD age out of the Secure Act, which is age 72 now. She'll have another year and a half roughly to defer money within her traditional IRA before she has to take required minimum distributions. But if you look at the combined required minimum distribution for both. By 2023, it'll be 45,000 when Chom and Jones are combined. So the question is, how much of this 45,000, which by the way, they're withholding 20% for federal and state income taxes. So the combined will be from 45 down to 36,000 after taxes. How much of that 36,000 of net RMD income do you want to spend yourselves or gift to grandkids, for example, or make Section 529 educational plan contributions to? I always tell my clients the first thing, get out there and spend your money. You've taken the time and worked hard to accumulate it, have some fun. But after that, is there anything left over that can be utilized to create this tax-free legacy to deal with the taxation problem to your children and grandchildren when they inherit your taxable IRA money? And they happened to say, came back to me and gave it some thought and said that we can comfortably reposition $10,000 of this net RMD income each year and put that into life insurance each year. And let's explore that and see what amount of life insurance that can create. I'm an electrical engineer by degree, so I tend to be a little on the analytical side. I like creating things that give people a good visual as to what's occurring and what we're looking to accomplish. And in this case, I created a required minimum distribution calculator that I do for all my clients. And you can see here, this is Tom's. In 2020, he's 72 years of age. He had $770,000 in his IRA at the end of 2019. The factor for him is 25.6, as you can see. And if you divide 25.6 into 770, that gives you his RMD for 2020 at a little over 30,000. I assumed in this analysis a 5% growth rate on the IRA going forward. And if we just assume that, then you can see that the RMD amount every year is going to rise. This is a neat thing that clients like that I do for them, because every year they can actually go to that value of IRA at year end and simply plug in the actual amount each year, and it will automatically calculate what their RMD will be for the following year. So I did the same thing for Joan. You can see here that she's not subject to RMDs until 2023. When she's 72, her RMD is scheduled to be about 15,000. So that's where the 45,000 in 2023 will come from. But what we'll do until then is simply take the $10,000 from Tom's net RMD. And then when Joan starts hers, obviously they'll have more RMD income, and the 10,000 will certainly just continue from the RMD. And you can see that her RMD amount is going to rise each year. So the $10,000 that they decided to put into life insurance just becomes a smaller and smaller amount of the total RMD income. My practice is independent, which simply means I can work with every single life insurance company that's in New York. If the client happens to own real estate outside of New York, let's say they have a winter home in Florida, for example, it allows me the ability to look at insurance companies in the state of Florida in this example as well. But my mission is to go out and find the best life insurance solution that exists. And doing the due diligence and looking at all of them. And generally what I'll do is present an analysis showing all the companies that existed, making sure the client knows that we're focusing on the absolute best solution. In New York right now, there's only 4 companies that offer a second to die life insurance option. They happen to be John Hancock, Mass Mutual, Prudential, and Principal right now. And that may change as we move forward, but I looked at the 4 of those for this client and found the best solution. When you apply for life insurance, you actually have a medical exam done, and just a basic physical that's done, and they're assessing your current health. In addition, they request your medical records from your primary physician, generally the last 5 years of records. This is at no expense to you. The life insurance company pays for both your records and this exam. I tell clients that what you're accomplishing by applying for life insurance is simply to determine your insurability and to see what health rating they assess you with. How healthy do they think you are? How long do they think you're going to live? What is your remaining life expectancy? And that's what they're doing when they do underwriting. And that's how they price their life insurance policies, are based upon how long they think you're going to live. And with second to die life insurance, it's kind of neat because you're insuring two lives. So they're more concerned about who they think, and they're more focused on who they think of the two is going to live longer. And they're kind of basing their decision on that. So you can see here that the best rating is preferred plus, then preferred, then standard plus, and then standard, and then a number of substandard categories below standard. And then uninsurable is just saying, the insurance company is saying, you just have too many comorbid conditions that you're just too much of a risk to us to insure you. But you have to have a number of conditions in conjunction with one another to be uninsurable these days. So I always tell my clients, if you have the resources, either on a discretionary income basis or non-IRA legacy assets to reposition to life insurance, at least go through the process of exploring life insurance and quantifying what potentially could be created. And that's what Tom and Joan did in this example. They went through the process and they ended up getting, both of them, a preferred health rating. They didn't get the best rating. They both were taking medication for hypertension and cholesterol, and they just didn't qualify for the highest rating, but they got the second highest rating of preferred. And for putting $10,000 into the policy, you can see in this schematic that they have little over $1.1 million in IRA assets. They know that that's going to pass 100% taxable to their kids when it's inherited. So of the $45,000 of ultimate RMD income, they're saying that right now we can reposition and into the future, take 10,000 of that each year, and we can comfortably reinvest that. And this is the place they're going to reposition or reinvest a portion of their RMD income. And they're just going to sock it away into this life insurance policy every year. And you can see that based upon their ages and their preferred health ratings, that putting in 10,000 creates an immediate $600,000 of tax-free life insurance death benefit right away. So even if, God forbid, they passed away in 5 years, the kids are still going to get 600,000. If they passed away in 1 year, they would get 600,000. So the 600,000 has been created immediately. It's just going to pass to the kids totally income tax free when the second of Tom and Joan happen to pass away. This happens to be, out of my analysis and my due diligence, John Hancock of the 4 companies currently has the best second to die life insurance policy. And this is what they implemented. It's called a fixed universal life. It's just something that they're going to put $10,000 in per year. And you can see it creates the immediate $600,000 of death benefit. And it's a policy that grows a cash value. It's not significant. The primary reason to create this policy is for the immediate $600,000. But what I want to show in this on this page here is that let's assume that Tom and Joan, the second death, they live for 20 years, and the joint life expectancy is 20 years. And they pass away in that 20th year. Well, let's say Tom passes away in year 17, and then Joan passes away in year 20. What's occurred is they've paid $10,000 into the policy from the RMD income every year for 20 years, or $200,000, for the kids to get a tax-free $600,000. So to me, that was an excellent place to reposition some non-needed income. And you can see in this last column entitled Internal Rate of Return, that 9.6% at the bottom of that last column, that's the rate of return, the after-tax rate of return that they earned on these $10,000 deposits over that 20-year period. That's an after-tax rate of return because the $600,000 is an after-tax amount or a tax-free amount that goes to the kids. So it just becomes an excellent place that is not subjected to the equity markets, the interest rate markets, the economy, the worldwide economy. You have certainty here. And that's what I like about life insurance for those who are retired, who have the resources to use it as a place to funnel non-needed income or use as an additional asset class to further their non-IRA portfolio into. It really should be looked at. This is a particular spreadsheet that I like to create for my clients who are looking at life insurance, because some clients might not want to put $10,000 a year in for the rest of their life. They might have the ability to fund it over 1 year only, or 5 or 10 or 20, and pick a finite period of time. Now, if you recall from Tom and Joan, they had $250,000 just in low interest CDs and savings, just sitting there languishing, earning nothing. They could have made the decision to say, you know what, we're simply going to reposition and take $170,000 out of our low interest CDs and plop it into this life insurance policy as a single premium deposit only. Nothing after year 1 is due. and turn a deposit of 170 into an immediate tax-free 600,000. So I have a lot of clients who have the liquidity, who have built up decent amounts of money outside of their IRA, whether it's in savings or CDs or tax-free funds or a taxable brokerage account, wherever it may be. But they've been able to save money outside of their IRA as well, or they've received inheritances like Tom and Joan did, for example, but they decide to fund the policy, not yearly, but just with a lump sum, or maybe over 5 years or 10. But you can see here that if you go 20 years out, that, paying for it with a lump sum is just 170. If they paid for it over their lifetimes, it'd be 200. So, paying for it with a lump sum will minimize what has to go into the policy. And the rule of thumb is the life insurance company will always prefer to receive the largest amount of money in the quickest period of time. So that's how we can minimize the input going into the policy. But it's completely dependent and individualized based upon the client's financial situation and their resources, whether they have comfortable discretionary income or whether they have non-IRA money they've been able to accumulate over their lifetimes. So this particular page I create because not everyone that I meet with who's married is 72 and 69 years of age. But I created this because what if Tom and Joan were, go down 2 and you see that 62 and 60. What if they were 62 and 60? They were still over 59 and a half years of age. They still could take money out of their IRA without the 10% pre withdrawal penalty. So that's not a concern. So if they were younger, you can see instead of creating 600,000 at 62 and 60, they would have created $1,046,000. So obviously the amount of life insurance that's created is dependent upon the age you are when you apply for it. So this is not just for people who are at RMD age. It's actually better for people who are 60 to 70 years of age, pre-RMD ages, that have accumulated large amounts in their traditional IRA and have the ability to. I have had a lot of clients simply say, I don't need to take money from my IRA yet. I may still be working in my young 60s, for example, but I know I can take money from my IRA. Why don't I take 1% or 2% out right now, pay the taxes on it, and put that net amount into the life insurance policy right now? That's a way we can control the growth of the traditional IRA, is to start taking small withdrawals right now, in addition to considering doing some Roth IRA conversions. But if I meet people in their 60s, these are the areas that I'm focused on for them, especially if they're those who have done an excellent job of saving in their 401k during their working years and have built up large amounts in those type of accounts. You should be looking at things like this, is looking at life insurance before you're of RMD age and looking at Roth IRA conversions as well. But now on the flip side, scroll down a little bit, see that 76 and 75-year-old. I've met with many people in their 70s who are still very healthy and can still qualify for life insurance at good health ratings. And if this couple was 76 and 75, they still would have created $378,000, you can see, by putting $10,000 in. So it still makes sense. And I always, again, stress that people just quantify. Allow me to do the due diligence and assess your health. And I can just simply come back to you and say, this is what can be created. I'll never be the one that says, this is something you should definitely do. I educate you from A to Z, and then you tell me, once you've gathered all the information, whether this makes sense for you to incorporate as part of your legacy planning. So the question again is, do you want your kids to lose out on a third or more of their IRA inheritance due to the recent changes to the stretch IRA rules? I'm hoping the answer to that is an emphatic no. Let's at least explore some of the legacy planning strategies that can be utilized to prevent that from occurring. So my focus in working with clients is to educate you on what can be done, what strategies exist, particularly post-Secure Act, that will create a scenario where you've got the peace of mind of knowing that when you ultimately do pass away and your assets transfer down to your children, that you know that none of it is going to pay for taxes, whether it be income taxes or capital gains taxes or potential future estate taxes if if the estate tax exemptions ever go down to where they were in the late 90s, I don't think that'll occur, but you never know. And life insurance is just used as an excellent hedge against any possible future, tax law changes. So, when you work with me, just go through this. I'm going to perform an analysis and understand your current financial situation from both an asset and income standpoint. I want to know what your resources are, what you have. Do a good job of summarizing what you have. And I love when people come in with just a page or two, summarized what they have. And, if they're married, how much does the husband have? How much does the wife have or the partners have? And how is it owned? And who are the beneficiaries? Who are ultimately going to be the heirs of your estate? What type of planning have you done thus far? Just obtain a high level understanding of your current financial situation, but then also take the time to really understand what is it you're looking to accomplish? What is your goals to protect your assets while you're alive? And how do you want to maximize the passage of those assets from a legacy planning standpoint? So with all of that information and that understanding, is there ways that we can utilize your existing resources, either again on a discretionary income basis or utilizing some dormant, non-needed legacy assets that are on the taxable side? Can we use those types of resources to reposition into life insurance? I am really doing the best I can to try to get people to look at life insurance as an asset class, as a separate and distinct asset class that they can diversify their overall portfolio into, particularly those who have money outside of an IRA that they've accumulated, particularly Roth IRA assets. That is a big place where people are shifting some of their Roth IRA assets. I had a client that had, I think, $400,000 in a Roth IRA, and they were in their mid 60s. And they simply moved $200,000 of their Roth into life insurance and created $800,000 of life insurance in a second to die plan. Now what do they have? They still have $200,000 in their Roth. They took $200,000 out, moved it in as a single premium into life insurance, and now that created an immediate $800,000. So before they had $400,000 in their Roth, now they have $1 million of assets, 200 still in the Roth, and $800,000 of tax-free death benefit. That created $600,000 of immediate tax-free wealth, which the kids will be the beneficiary of, which they'll be able to use to pay the income taxes on the traditional IRA assets that this couple had. So I've just done some neat planning for individuals. So, when I understand your situation, that's where I'll put my teacher's cap on and just educate you on what strategies exist to accomplish specific objectives. So relative to, potentially exploring how I may be of help, there's a number of ways that we can get in contact with one another. I give the ability to have a free 30-minute phone call. We can just sit and chat on the phone and get to know one another. And in that phone call, you can see if there's potential chemistry and get an idea of whether Bill Monty knows what he's talking about and is knowledgeable in the areas that he professes to be. But again, my role in that consultation on the phone initially will be just to kind of assess, like I mentioned, your current financial situation and what your concerns are, what's your objectives, what do you think the missing pieces of your overall puzzle happen to be. And then from there, maybe it potentially leads to you attending one of my workshops once they begin again. Unfortunately, with the COVID situation, they're probably postponed at least till July, but I'll certainly let you know about those. But hopefully it'll lead to maybe us getting together personally. I know that we're able to do that, I think, as of June 1 in New York State. But in essence, my role, again, is to help you protect what you have while you're alive from long-term care costs, and then maximize what is passed on to your ultimate heirs. So, certainly feel free to reach out to me directly. If you want to call me, my office number is 721-2385. It happens to be my cellular phone number, so you can contact me at that number at any time. You can click on this link, this Calendly link, which actually will lead you right to my website. And you can schedule a time at your convenience on a calendar that will pop up, and I'll see that, and we'll be able to communicate that way. So it's kind of up to you. On top of that, if you want to learn more about me before you reach out to make contact with me, I actually did an interview of my practice. Actually, a client of mine, Mary Salento, she has actually done the All About Town uh, TV program. She lives in East Rochester. She's done it for over 30 years. And she was always asking me, Bill, let me interview you. So I finally said, okay. And, we actually did it right in her family room at her home in East Rochester. And I came into it kind of with a little trepidation, but it ended up turning out okay. It's about an hour-long interview. So if you want to treat it as a TV show to watch, I think you'll get a lot out of it, and you'll get a good understanding of what it is that I do in the specialization of my practice. So that's one thing I would recommend that you watch. Obviously, you can plan to attend one of my workshops, which I do at the Parenting Community Center and the Brighton Recreation Center, and also the Webster Recreation Center. I do those each month. They're generally the last week of each month, and they probably won't start until July, but I can certainly keep you posted. And then you can hop onto my website, which again happens to be legacyandltcplanning.com. I would suggest that you just kind of check me out and do your own due diligence relative to who Bill Monty is and my background and expertise. You can certainly connect with me on LinkedIn as well through that link. So I'm hoping that we have the chance to at least chat with one another. Again, I allow people to chat with me at no expense. You can come see me at no expense. We can have as many meetings as you want. I never charge for what I do. I like being an informational advocate and resource for people, particularly those who are nearing retirement or already in retirement who have long-term care and legacy planning concerns. That's what I'm here for. So I'm hoping that we can connect with one another. And I've given you a handful of ways to reach out and say hi. So I look forward to chatting with you. Thank you again for taking the time to watch and listen to this webinar. And hopefully we'll be chatting with others soon. Take care now. Please be well.